Uh. Yeah.
Protect yourself against the risk, and then reduce income fluctuations. Before options were actually available, first what happened was the people who are rich, they kept buying shares and shares, investing in the companies, and the value of the shares kept going up and up and up. But the problem is they were not getting anything in return. In their hand, they had to sell the shares. They didn't want to sell shares. They wanted to create value, but they didn't want to sell shares. So they said, okay, we need to figure out a way to make income. So that's when calls were born. So it wasn't the puts that were born, it was the calls that were first born in option. What did they do? They said, okay, if I have a stock 300 rupees, the stock, they bought it at 100 rupees. They said, okay, if the stock is at 320 this month, I'm willing to sell it and walk away. So they started selling calls. So when they started selling calls, what happened? The people were available in the market to speculate and buy those calls, and hoping that the price hits 320 so that they can start owning the stock or start making more money out of it. So what happens when you write empty calls? There are a lot of people who can buy calls. So buying calls, what does it give you? It gives you the speculation right. So buyers joined the market and started using options to control stocks with very minimal investment. So very little money they brought into the market and they started speculating. Options got innovative. Now let's look at options contract. Option contract is between two people where one acquires the right and other undertakes the obligation to fulfill that person's right. Though it looks very complicated, so it's a very, very simple thing. So now let's look at it a little more detail. So we'll look at a call and we'll look at also a put. So this is a call example. It's a beautiful house. I know it's in the middle of nowhere. This is my house in Mauritius. This is hypothetical, of course. And I priced it at 1 crore. I'm not telling you what is the market value. I'm not telling you what it is and which is high, low. I have priced it at 1. And you're visiting Mauritius and you want to buy it, but you're not sure, because you don't know the market value, right? So you see that's 1 crore. Okay. So you want to give me a token advance of about 1%. So we make a contract for the advance that you make. I hold this contract and say, okay, I'm supposed to hold this for 3 months. And you say, you become the options buyer here. You have the right to buy this property at 1 crore and you have paid me a premium of 1 lakh. Me, I'm the option seller. I've given you the option to buy this house at 1 crore. So my obligation is whatever the price of the house is, if it is 1.2 crores or it is 90 lakhs, my obligation is to sell this house to you for 1. And for this obligation, you have given me a 1 lakh as a premium. So for this waiting period, I get 1 lakh rupees and I keep it. 3 months I wait. You come and buy this. Good for you. If it is going up, if it is below, probably you will not bother to buy this property because why would you buy a property for 90 lakhs when you made a contract at 1? So this is a typical call option contract. Two sides. One is a buyer. Another person is a seller. Now, let's look at puts. Now, for better sake, we'll say that this is your car. Probably some of you own this car. We'll price it at 1 crore. You want to buy an insurance for this car. You have priced this car at 1 crore. Insure a car 1 crore or 1.5 crore. Under insurance, insure it for even 75 lakhs. You have put it at 1 crore and you've insured it for 1 crore, giving me 1% of your car value. You've made a contract and you want the insurance for 1 year's period. What happens here? Again, you're the buyer. You have the right to be protected for this car to about 1 crore. It gets stolen, it gets damaged. Anything were to happen to this car, you will be compensated up to 1 crore rupees. And then you paid a premium of 1 lakh. As a seller, I have the obligation to make good your 1 crore of loss. And I get an income of 1 lakh as a premium to ensure that, I make good your loss of 1 crore. If you don't do anything to the car, then I get to keep that whole 1 lakh. If the car gets into an accident, then I end up paying you that 1 crore or whichever is the lower price. So now let's extend these two examples in an options contract. So as I said, there's a buyer and there's a seller and this is the contract. So you have a value or premium is paid for exercising the right to buy. So in the house, you have the right to buy. The premium that you paid is 1 lakh for the house of 1 crore. Similarly, you had paid a premium of 1 lakh for the car insurance also, at a specific strike price. So if you look at options, there are various strike prices. What are these various strike prices? Various strike prices are at different point of time you're making at different price levels, you're making a contract. You could have made a contract at 90 lakhs also for that house. I would have changed the premium according to that. You could have undervalued your car and you could have made the car at about 70 lakhs. Then my premium I would have charged you a lesser premium as options writer. So that is what is the specific strike price. So here in the last two examples, the specific strike price we've entered into a contract is at 1 crore. And then specific time to expiry. So all options have a specific expiry. So you have a 3 months expiry in the call option that I explained, and then on your put you have a 1 year. After all the complications that you would have known or you would have come across in options, there are only two things that can happen in options. Your basic positions are you're either long in the market or you're short in the market. If you're long in the market, you buy a call, the market goes up, the stock goes up, you make money as high the stock. If you're short in the market, you're expecting the market to fall. So you buy puts. Like Punjab National Bank, you think that it's going to fall further and further, you would buy a put. If you think that the Nifty is going to go up or ICICI Bank is going to go up, you buy a call and hold, and as high as it goes up. And of course, as I said, it has a specific expiry. The other side of the coin is a person who's selling this option, if he thinks that the market is going to go up, which is long, he sells you puts. So in the example of the insurance, car insurance, if I think that you're not going to have any accident, the market is rising, you're not going to have any accident, nothing's going to happen to you, I will sell you puts, I'll sell you insurance premium and I'll pocket that money. And similarly, I would sell call in a market which is falling. You came here, you wanted to enter into a contract in Mauritius. I'm not in Mauritius, I'm just saying you went into Mauritius and entered into a contract and you paid what? 1 lakh for a 1 crore contract. But I know that the market value in Mauritius is actually 70 lakhs. And I know you are entering into a contract. I'm very happy. So I'm expecting the market, when you actually know the market value is going to be way lower. So I sell a call. These are the two sides of the coin. Of course, the sellers have a limited profit and unlimited loss. And your buyers have a limited loss but unlimited gains. Everything is limited at the end of the day. It's not there's nothing called unlimited. It's how much risk that you can take is what it determines. So after all these things, why not just stocks? Why do options? Stocks, it's simple, right? You know the direction, you can make profit from it. It's as simple as that. Everybody can make money if they get the directions right. The price is readily available. All that we need to do in a stock is you have to just buy it low and sell it high. And then if you make a mistake in stocks, not a big deal. We can always hold it for long term and, eventually it will become profitable. Of course, if you are invested in Kingfisher or something, then you're in trouble. Other than that, normally, over a period, probably 5 years, 2 years, or probably next day, never know, but over some foreseeable future, hopefully it'll climb and, you'll be profitable. So if you make a mistake, you can still walk away with the stock in your hand. It is the safest investments, of course. Your mutual funds are in it, government pension funds are in it. You can know the whole machinery is in it to invest in the stock market. Options, it is complex. There are too many strike prices. As I said, you can enter into a contract of 1 crore, 75 lakhs, or you can undervalue a car and you can enter it for 50 lakhs. There are too many strikes. And you have calls, you have puts, and it is multi-directional. When I say multi-directional, the stocks, options, you can make an option for up market, down market, sideways market, and it requires a whole lot of effort to analyze. And this information, for whatever it's worth, it's not readily available. I'm not saying it is not available. As I said, it is not readily available. So you'll have to dig a little more to find it. So if you're new in the market trying to figure out options, you would not be able to find it or understand it easily. Where I came from, there's nobody is teaching options in simple words, putting together some content and making it simple for everybody to understand. So that's a gap I'm trying to bridge. Let's see how far I can go. But this is what is the problem with options. Having said that, my question is, why not just options? Why do you need to look at stocks? Options can be traded in bullish market, bearish market, neutral market, where the market is going to stay within the range and you're not even bothered which direction the market is going to go. Whichever direction it goes, you want to make money. The direction indifferent. And you can control this whole stocks with a very small capital using what's called the leverage. And then you already know the probability. Coming up slides, you will know that how you can understand the probability of your success when you enter an options trade. When you enter itself, you know what is the success rate going to be. That's fantastic. It's unlike stocks. You need to get the direction right. In options, you already know the probability of you being right. Then you can create various strategies. You can employ time value, again, as a probability of success. And the most important thing, the variable that the market, when you buy stocks and sell stocks, it doesn't take into account is the volatility of the market. That is something that you can learn to take advantage of. As I said, your stock success is 50%. It's just binary in nature. You buy a stock, you keep yourself a stop loss, and you hope that the market doesn't hit the stop loss, then it goes up. And of course, I'm not taking the credit away from whatever analysis that you do for making this judgment. But remember, stock is binary. One side only, you'll make money. You buy a stock, it has to go up. If it doesn't go up, you don't make. But in options, it's not that. When you do a right strategy, your success rate is as high as 70% and with very limited risk. And remember, stock gains are notional in nature and it's not realized until you actually sell it out there. Yes, you can have a stock which is for 100 rupees and it is quoting at 500 rupees. What's the big deal? You're getting dividends, hardly, right? I mean, if you don't get the dividend, you're not getting anything out of it. Dividends is very tiny piece of it. You're really not making any value. But options are not like that because they have a certain expiry date. Options expire in cash at the end of every month. So you get your act together right, then you will end up with cash at end of every month. Now, option writing, as I said, I'm a writer. So why would you not look at option writing as a business? The advantages, as I said, profit you will get as cash. If you're profitable, you're a good options writer, you'll get it at the end of every month. And time is on your side. As you would know, the options contract, the premium value goes lower and lower and lower as it gets closer to the expiry. So time is already working in your favor. And you get a premium for the risk that you take in the market. But the moment you sell an options contract, you are assuming the risk. So the exchange says, okay, you need to get this credit. So you're given this credit in your account. Of course, you have to pay a margin money if you have to get into a loss and other things. But you already get the premium upfront into your account. The disadvantage is that the margin required is large. If I were to buy a nifty options contract, at the money options contract today, 10,500, you're going to go ahead and buy a contract, call or put. You have to bring in 55,000 depending on the broker on an average as a margin. So one contract you need to bring in for 75 units, you bring in 55,000. But if you're an option buyer, if it is quoting at 100 rupees, so 75 into 100, that's all is your outlay. Hardly anything. So that is a big disadvantage. You have to bring in more capital, which is being locked in by the exchange. So you need to have the margin. And then the losses are unlimited. Yes, losses are unlimited. If you don't know what you're doing, you don't know how to write options, you don't understand options, and you see that the strategies that you go out there and doing are incorrect, then you would definitely have unlimited. Again, unlimited, as I said, is the overstated word, and it's not that unless the stock which is at 100 goes to zero, not unlimited, just about 100, right? Again, if it goes from 100 to 100 and 200, 300, I doubt it's going to go like that in a month's time. So that's why the unlimited theory is kind of overstated, but you need to know what you're doing when you do options writing. Next, even more interesting part. So we will talk about the intermediate level where we'll look at what are option contracts, option chain, moneyness. So this is a very important term that you need to learn when it comes to options. Then options premium. Then why do buyers lose money? If you're not losing money, as a buyer of options or a buyer of futures, you've just been lucky. It's coming. It's just not easy to be consistently making money if you're a buyer. If you're doing it, it's fantastic. And then why do sellers consistently make money in the market? And then we will talk about the option Greeks and implied volatility. Probably implied volatility we will talk before the Greek. Okay, now option contract components. So this is a call and a put. I've plotted it for you guys. This is what you would typically see in the NSE website or any of your brokers platform that you have. This is what you would see. First, you will have, of course, your symbol. It could sit anywhere, but you will have your symbol, then the expiry date of the contract. Then what is the contract type, whether it is a call contract or a put contract. I'm not here to explain, American and European and all this. We are using a European. People have to go and figure out what it is themselves. It's not a big deal. It's more theory. So this is your call contract and your put contract. Next, you have your strike price. Strike price for call, strike price for put. And the most important, of course, is your premium. So this is our typical contract when you enter, when you buy or sell will look. This is a screenshot that I have taken from NSE's website. This is the option chain of Nifty. Nifty price here is 10,192. For our discussion's sake, we will say 10,200 is what the Nifty's price is. The center are the strike price. So if you look at it, you have strike price of 10,008, 9,850, 9,900, 9,000. So You remember we had this discussion of what are calls, where I explained about entering into a contract at 1 crore, or you could have entered it at 99 lakhs or 98 lakhs, or even entered it at 1.2 crores, right? So these are the different strike prices that you can enter into a contract. That's exactly is here on Nifty. Strike prices are regulated by the exchange. It is in the breaks of 50. Next is the open interest. Open interest is nothing but how many contracts. Contract is what? Between two people. One is a buyer and another is a seller. How many contracts are open on the call side? Left is your calls. Sorry, I didn't say that. Left is your calls and right is your puts. So left, you have your open interest on calls. Right, you have your open interest on your puts. The contracts which are open. Next is the volume. So what is the volume that is getting traded on a contracts which are opened and closed over a period of a day? What is the volume of these contracts? Then implied volatility. So this is a very, very important element that you will be learning shortly. So implied volatility is what is the expectation of this option price going to be. So this is the IV is the expectation, implied volatility that the market has on the price for each of these strikes. All options and futures expire on the last Thursday of every month. Next, let's get into this concept of moneyness. Remember, ITM means in the money, ATM at the money, OTM out of money. I'm explaining this with an example. This is very critical. If you don't know this, you will probably have to be active and listen to this properly. So stock price, we are taking it as 100, and left hand side we have our call options, right hand side we have a put option. If you look at it at 100, if you enter into a contract at the same price where the stock is, it is called at the money contract. For both call and put, it is a at the money entry. 100 rupees stock price, strike is also 100, it is at the money. On the call side, in the money, anything below the market price. Market price here is 100. Anything below the market price, it means it is in the money. 80 rupees, 90 rupees. Imagine in that same house example, I'll keep going back so that it's easier for you to register it in your mind. So if you go back, if you enter into a contract, let's say you knew the market value of the house in that area is 1. You are entering into a contract at 70 lakhs. It means that at any given point of time, you can just walk away with that 70 lakhs contract, right? You are in the money. So 80 rupees, if I enter into a call contract, it becomes in the money. And if you enter into a contract above the market price, like 1.2 crores, the market is 1 crore. You're entering into a contract 1.2 crores. So market value actually has to rise to 1.2 crores for you to actually make money. You understand that? So that is out of money. Here in this place, the stock is 100 and you're entering into a contract at 120. So what happens? The stock has to cross 120 for you to actually make money. So that is out of money for calls. Similarly, for put, it is the opposite. So your car value is 1 crore. You are making a contract and you're insuring the car at 1.2 crore. What does that mean? So if you lose, your actual car value is only 1 crore. But if you lose, you are asking for 1.2 crores. So that is from a put perspective, it is a in the money contract. And what is out of money? When you enter into a contract at 80 lakhs for a car, where you know that the price of the car is 1 crore, you're undervaluing it, right? So you're willing to take a loss of about 20 lakhs. So here, you're entering into a contract saying that, okay, I want to in the money, 100 rupees is the stock price, but I will enter a contract at 80. So if the stock falls below 80 is when you actually will start making. So that is the concept of in the money, at the money, out of money for both call and put. If this is too much for you, you probably go out there, and this is a very simple concept. Try and understand this. This is the base for all your options. So I'm extending this again. So let's look at same option chain. Nifty is at 10,192. For our assumption, we'll call it at 10,200. 10,200 becomes the at the money for both calls and puts. Got it? And 10,000, if you were to enter into a contract, buy a call, it is an in the money. The same time for puts, it becomes out of money because you're entering into a contract when the market is at 10,200, you want to be made good at 10,000. So that is why it is out of money for put. Similarly, out of money for call, 10,400 becomes out of money because market has not even touched 10,400, but you want a contract, you are entering into a contract at 10,400. So it is out of money and it is in the money for puts. Yeah, this is really messy. You can ignore it, but I hope that you guys understood this concept of in the money, at the money and out of money. This is key concept that you need to drive home and keep it in mind. Now next, Yes, we entered into a contract, but what is the value that we are paying, the premium, what it is? We'll have to understand the premium, the components of the premium that we pay for an option. There are two components for the option premium. One is your intrinsic value and extrinsic value. Don't let big words confuse you. Intrinsic value is the real value. It's the difference between the strike price and the spot. That's what is the intrinsic value. Strike price, in the previous example, spot price is 100 rupees, strike price is 80 rupees. So difference between that is your intrinsic value. And then extrinsic value is the notional value for which you actually pay a premium. The premium is actually your notional value which is there built in. Your extrinsic value has three components. One is your time to expiry, how many days you have for expiry. And then it is driven by the implied volatility of the market. What is the people's expectation of the price going to be? So that gets priced in. And then rate of interest. Again, now let's look at this through an example. To understand the options premium, what is the real value and what is notional value. So on the options premium front, you have your in the money, at the money and out of money. Here we are taking an example of call option. Stock price again is 100 rupees. At the money, which is stock price is 100, strike price is also 100. The premium is 15 rupees in this example. So what is the real value? So the difference between the stock price and the strike price. So 100 rupees is the stock price minus 100 rupees the strike price, which is 0. The remaining amount, the premium minus the real value that you have is your notional value. So 15 rupees is your notional value for at the money call option in this case. What happens in the money? In the money, let's say take the 80 rupees strike price. The premium is quoting is 35 rupees. So the real value is 100 minus 80, which is your stock price minus the strike price. 20 rupees is the real value. The value already which is there in this contract, 20 rupees. Because you're entering into a contract at 20 rupees lower, then what is the market value? So you already have that 80 rupees. That's the real value of the contract. The premium is the notional value you're paying in addition is actually 35, which is the premium, minus the real value. 15 rupees is your notional value, which is called the extrinsic value. Now going to the out of money contract. If you look at it, 110, 120, let's take the 120 out of money when the market is at 100 rupees. 120 rupees you enter into a contract to buy, you pay a premium of 5 rupees. So what happens here? What happens here? So you have your, just give me a second. Whoever unmuted, can you just mute back? It'll be good. Thank you. So what do? You have your 100 rupees is the stock price. The strike price is 120. It's kind of negative, right? So the real value on the stock itself is 0. So there's no negative value of stock. So it is 0. The only thing that you're paying is or buying is 5 rupees, which is a notional value, which is your premium, extrinsic value. So this is how an option premium has to be looked at. A real value, which is your intrinsic value, and the notional value. All out of money or at the money contracts don't have any real value in them. Only in the money contracts have real value within them. Moving on, why do buyers lose money in the market in the long run? Yes, I mean, you can see this picture. I mean, it's not because of this guy, but you already got the concept. This is a very classic concept. If you had already tried to learn about options, this is something that you would have seen. This is a roulette wheel. If you go to Goa, or probably if you're traveling internationally, if you go to Macau or Las Vegas, this is something that you would find. This is a typical roulette wheel. What happens in the roulette wheel is you have 36 slots. You have your black slot and you have your red slot. So how this game works is you have a right to bet on each of this slot. You bet on, let's say, black, you get 1,000 rupees you bet. You get, if it hits the black, any black, you get 1,000 rupees. It's like 1:1 profit you make. So there are typically 18 reds and 18 blacks in this. And your odds of winning any of the colors that you choose, black or red. If you pick a specific color, your money will be higher also. But normal gambling, black or red, whichever color you choose, what happens is, if you win in red, your chances of winning is 49%, black 49%, casino's edge is 51%. Why? You have that one ball, which is your 0, which is in green. If it hits there to your luck, the casino takes the money. And of course, if you hit a black and the ball stops in red, casino keeps the money. You got it? So that's how a roulette will happen. So your typical chances of winning is about 49%. When you spin the first time, your chances of winning is 49%, and casino has an edge of 2%. They're only running the whole infrastructure. So you have to give them the edge, right? So they need to make something. So 2% is their chance better than you are. So let's say you don't win the first spin. You start spinning and spinning and spinning. After about 100%, 100 spins, your chances of winning and actually taking home money comes down to about 36%. And you still keep spinning and spinning and spinning. After 1,000 spins, 19% is your chance of you actually making money and walking away. After about 10,000 spins, you don't have a chance of making money and walking away. All the money the casino has just taken, and you will never be able to make up that money ever again. So that's what is about casino slots. So think of each of these casino slots as strike prices. You're picking a strike price and you're betting on it, right? That's how you would probably want to look at it. But buyers lose money over a period because they keep buying and buying, and the odds keeps coming against them at all point of time. Why do sellers make money in the long run? Buyer, seller. We will look at this in a options contract. A simple option contract, Jan 5th, Nifty spot was 10,558. Call was available, 10,600 call was 91 rupee 95 paise. Jan call 10,500 was 77 rupee 95 paise. Okay. Buyer buys one lot of each. He buys a call. He pays a premium of 6,896, and he buys a put. He pays a premium of 5,846. Okay. So buyer, what happens? His total cost is 12,742. The total cost is 12,742 for this buyer. So this is not so much money, right? One contract each. But for a seller, as I said, for every contract that you sell, you have to bring in a margin amount of 55,000. For as an example, you can get it at a lower also. For a typical large brokerage house, this is what they would charge. So 1.1 lakh is the margin which is required for the seller. Buyer loses 100% of this 12,742 if the spot remains, of course, at 10,558. And if the spot does not go below 10,600 or below 10,400 or above 10,692, this has to move at least 1.3% because he's paid a premium. So he has to recover his premium for him to actually start making money. Whereas for a seller, he will lose the same 12,742. Even if he loses the 12,742, it is only 12% of his capital. Whereas for a buyer, it is 100% of the capital that he invested in a trade. Yes, seller is bringing in more margin, but we are looking at it as a percentage of capital employed. How much have you lost? So in this case, he's lost 12% if it actually goes 2.1% above 10,748 if it goes above, or it falls below 10,344. That is when he will actually lose this money of 12,742. Until then, he's going to lose way lesser than the buyer. And if it stays within 1.3%, the seller is going to keep the money to a large extent. So this is why, as I said, the sellers over a period of time, when they do things more strategically, they understand the Greeks, which we will simplify and we will learn now. He has more option to make money in the market in the long run. We are getting to the Greeks, but we've come out to about 4:30. So bear with me for about 15 minutes and we will get through this session, guys. And after that, we'll have a quick Q&A. So as I say, you don't need to know the working of an internal combustion engine to drive a car. You just need to know accelerator, fuel. If you fill the fuel, which is the brake, you can drive the car. You don't need to really know the engine, right? I mean, you're not an engineer. Having said that, we kick off into the most complicated things in options, which is your volatility and then your Greek. What is volatility? So we will understand volatility in two ways. One is your historical volatility and of course is your implied volatility. Volatility is the unknown factor. It's the human element when it comes to options. We cannot price it. It is a derived value when it comes to options. What is historical volatility? Historical volatility is the percentage of stock price fluctuates over a given period of time. So I have plotted a stock's move A and B over, let's say, 3 years period. The green one is the B stock, which is fluctuated up and down it has gone up, gone down, not so much of a fluctuation as against the orange stock, which has fluctuated way higher and lower and higher and lower. So this is a record of the historical volatile move of a stock A and B. So each stock, the behavior is different. But if you look at buying as a stock price, you just buy a stock, market goes up, you make money. I mean, if you sell a stock, market goes down, you make money. But you really don't understand how much it moves every day. What is the volatility which is built into the stock? So in options, you look at this way more. Next is your implied volatility. Volatility, as I said, is the percentage of stock price fluctuates without any regard to the direction. It is a positive number, whether it goes up or down. The difference which is moved is what is recorded as a volatility. Implied volatility is the expected price move. So this is, as I said, is a derived number. We don't know the value of implied volatility. You get when you have all the other variables and options. We are not going to learn about how to get it because it's already available in the market. You can go out there for each stock. It is available, and I'll teach you how to find the implied volatility for Nifty. So this is the typical implied volatility chart on a premium. But when you compare with the historical volatility, what happens? The implied volatility more often than not tends to be higher. People expectation, that fear and greed of the people tends to be actually higher than what the actual stock move that happens in a month or in a day. You understand that? So what people think and what actually happens is always a bit different, and people always overestimate, both in terms of fear and greed, than what actually ends up happening in the market. By now, with all the changes and all the things that have been happening in the market, you would have understood that now volatility, you hear that it is very low, it is very high. Volatility, it is all-time high. You would hear it in the press, you would hear it on TV, they're screaming all over the place. Volatility is high, very high. So what does that mean? What is the implied volatility, very high or low? What does this exactly mean? What it means is that you compare implied volatility against what the implied volatility was historically. Over last 1 year period, how the volatility was every day and how it is now. So volatility as a number has no meaning. You compare it against what was the historical. Historical is typically 1 year period. What is the volatility? When you compare against that period is when it actually has a meaning to itself. Then you can say, okay, compared to the historical volatility, historically what it was, now it is low, now it is high. You get that? So now we will also understand, yes, high, low, but how do you figure out what is high, low? So what I'll do is I'll give you an example of how you can find out high and low. Before we get there, when the volatility is low, normally the option premiums are very low in the market. When does this happen? When the market hits highs. And the market is people are complacent, people are very happy and celebrating. They are not. Option premiums are typically low. When is it high? When there is skepticism and there is uncertainty or there's any event which is coming up, the premium shoots up. It becomes high and very high. When it is low, you buy options because when you buy options, the premium will go up. If there is implied volatility, if there is uncertainty, people will be willing to pay much more premium for their option. And not necessary that the stock price has to go up. The premium will actually automatically go up because of the expectations of the people. Stock price can remain at the same level. So when you're options buyer, you are looking at a low to very low or probably neutral implied volatility range. If you're a high option seller, you would look at high because you want to take as much premium as possible in your pocket. Let's understand implied volatility. And like I said, high, low, medium, right? So how do we actually work out this high, low, medium? We will take Nifty. Nifty, as I said, the beginning, India VIX tracks Nifty's implied volatility. Closing as of February 2nd, it was 15.25. Now what we do is, we look at Nifty's 52-week high, 52-week low. 52-week low was 8.76 and 18.50. This is available at NSE website. It is available in Yahoo. Anywhere you go, 52-week high and low is available for Nifty. So you have to know how to create the rank of high, low, medium. The formula is very simple, very straightforward. You take your current implied volatility, in this case 15.25, you subtract 2-week low, which is 8.76, and then you divide it by the difference between your high and low, 52-week high and 52-week low. 15.25 minus 8.76, 52-week low, divided by the difference, 18.75 minus 8.76, which is 66.63. Now you got a percentage number. So normally implied volatility is anywhere between the range of, let's say, 0 to 100%. Let's look at how we can plot 66%. Now it becomes very straightforward. India VIX now, as I said, is it at 66%. We will break it down into 5 parts. We say, okay, less than 20%, it is very low. 20 to 40, we say it's low. 40 to 60, neutral. 60 to 80, high. Anything over 80, we'll say it's very high. So now 66, where is it sitting? So implied volatility is in the range of high. Get that? So that's how people say where the implied volatility is. So implied volatility is high. So remember, if you're going to be an option buyer, you're going to pay way more premium. If you're going to be an option seller, it's going to be working your way. So this is the grading of Nifty. If you now that you've understood it, you probably have a little more edge than what other people would typically have in the market. Now let's move to the next important things. With the implied volatility, you have delta, vega, theta, gamma. So don't let the words confuse you. I mean, imagine or keep delta as the probability, volatility tracker as vega, theta is the time, and gamma is the change of delta. So what does delta probability means? When I say delta is a change in option price for every change in the underlying, for every unit change in the underlying. So Nifty, let's say it's 10,500, it moves to 10,510 or 10,600. How much does the strike prices, each of the strike price premiums move by? Whether it's a call or a put, that is what is delta. Delta is at each call and put at each strike level, you have a delta. It is used as a hedging tool, and also when you look at delta, it is also used as a probability of an option expiring, whether it is expire in the money or out of money. It helps you find out. It gives you the outlook. Next is your vega. Vega is nothing complex. You no implied volatility. Vega is measuring implied volatility. So it's nothing. It has no than a mathematical value. It has not much meaning. It's the premium which is there because of implied volatility. That's what is vega is all about. And then your theta, which is your time decay of an option premium every day. So as the day goes by, the option premium keeps falling slowly and slowly and slowly. That is the time value, time decay. Then gamma is how fast the delta is moving. So when the market moves from 10,000 to 10,100, the deltas change of each of the premium. So when it moves, how quickly the delta changes is what gamma's workers track. So as I said, delta, it measures the change of an option price. The calls are positive for delta. It is anywhere between 0 to 1, and puts it as negative delta. Example, if a call has a delta of 0.5 and the stock price goes up by 1 rupee, then the price of the call will go up by 50 paisa. That's what it means. So 0.5, it will go up by. Similarly for put, if the delta is 0.5 for a put, some specific strike price, then the stock goes down by 1 rupee. In theory, the price of the put will also go up by 50 paisa because it's a put, right? The price goes down of the stock, so put value. In normal traders terms, when you go and look at delta, when people say that, delta is 0.75 delta, it means 75% is the chance for your option to close in the money. So let's say market is at 10,500, you bought a strike of 10,200, which is in the money strike. So the probability of that strike, delta of the strike will say 0.75. You're already in the money. So what is the chances of it, market falling to 10,200, you losing money is lesser. So you will still hold the real values. So that's why the probability, it determines the probability of an option being in the money. Here is your delta chart. At the money, I've taken for a call option example. Delta, as I said, is the probability of an option closing in the money at expiry. At the money, delta is 50.5. Why is it 0.5? As I said, option, as I am a neutral options writer, option by itself is neutral. Delta is a neutral strategy, is used for all neutral options writing strategies. So at the money, delta is neutral. If you are in the money, the delta becomes higher. Your chances of closing in the money is higher. So 70%, the market stock price is at 100, and in the money 80 rupees strike price, the delta is 0.7. Buyer, if you're a buyer, you have to buy in the money because your probability of it expiring in the money is higher. If you're a seller, you look at selling out of money because there's a low probability of an option expiring in the money. So it has both buyers and seller. So if you're a buyer or a seller, both of you may take advantage of the delta. Now theta. Theta is time value of an option. Theta, as I said, time doesn't stop for anyone. As it gets closer to expiry, it starts accelerating, just like life. As it gets closer and closer, things start moving way faster. Theta is the value of option premium that will decrease for every 1 day change. This is a typical theta chart. This is a 90 days chart. So at 90 days, what happened? When you like the premium of a contract at 90 days was 290 rupees. 90 to 60 days, 30 days have gone past. Now with 60 days to expiry, same contract value is about 160. The time value has eroded the premium in that contract. It's about 30 rupees is the erosion that has happened. From 60 to 30 days, you can see that 260 to 180. The 80 rupees is the erosion that has happened. In the last 30 days, from 30 to 0, from 180, it becomes 0. The premium, the extrinsic value of the stock. So time, if you're early, it is your friend for a buyer. But for a seller, he loves last 30 days because the time will start crushing your premium. If you're a buyer, you buy as early as possible. Not 30 to 90 days, no Indian market, we don't have any options which are open. So you try and get into option buying as soon as the contract opens or the next month contract has some, liquidity available in it. Sellers love it. They keep selling it because in the last 30 days to expiry, the premium starts crashing very fast. This is a theta diagram. So as a buyer and seller, this is how you're going to use your theta. Vega, as I said, I'll not waste time. It just measures how much of volatility is moving. Then next, gamma, again, I will not spend time. You can look at it at your own free time. Gamma just measures how the delta is moving. If you understand delta, gamma just tracks the delta. And it is a buyer's friend because the faster the probability of change happens, for a buyer it is good. But for a seller, I don't want probability to change because I am already doing it out of money. I don't want to come in the money fast, right? So gamma has to be slow for a option seller. Gamma becomes fast during the last week of expiry. So option sellers normally square off their positions fast and roll over to the next month in the last week of expiry. Rho is nothing but it tracks the interest rate. So what is the rho? Is the carrying cost of an option. So when you're buying option, selling option, what is the carrying cost of the option? So that is measured by rho. We have only 1 month contract in India, so rho is not much of a value. So next is psi. So this is something, if you're investing in stocks, please keep this in mind. Stocks have dividend declaration that happen. So if you see that the stock is, when premiums are low for, calls or, the put premium is high, you really need to go back and see whether there is any dividend which is pending for this company. So it measures what is the impact of the dividend yield. For calls, psi is negative. For puts, psi is positive. So as I said, dividend affects premium. If there is high cash dividend, if it is coming to be paid, your call premiums will be lower. So don't think the calls are cheap and do something and sell calls. Similarly, put premiums will be higher. So you'll have to keep in mind, you have to stay wary when you get into stocks, option writing or options buying. We're getting to the last slides. Now, prerequisites, key takeaways from options is that you'll have to pick liquid stocks. You'll have to pick Nifty or Bank Nifty for your option buying and selling. Bank Nifty is too volatile. I would probably, if you're starting, stick to Nifty. If you're getting to stocks, do it during earnings season. If you're doing writing of options, if you're buying options, then you can probably do it, even in a low volume section. But you'll have to be wary that, your bid ask will be little stretched when you do your options on stocks. Then before you get into anything, if you get into options, ensure that you write down your assumptions. You're going to go, the market is going to go up. If you have technical knowledge, you use the knowledge, say market direction is high. It's going to be south or it's going to go up or there's no direction is going to be in the market. Then you should know the implied volatility. By now you would have known that implied volatility rank is sitting on a specific range. So see which grade it is sitting at. And based on that grade, you have to pick a right strategy. So we're not discussing strategies here. You can go out there and Google for it. What strategy to do in a low volatility environment? What strategy to do in a high volatility environment? That is something that you will have to ensure that you do. If you pick a wrong strategy at a wrong volatility environment, then you will never be able to make money. Even if you make money, you got lucky. The risks are way higher. And then you should know the probability of your success, which is your delta. Then when you do your trade, your risk versus return, keep it at about 1 to 1.5% at least. And if you're not sure, please don't take the trade. It is okay. Then top mistakes that option traders make, both buyers and sellers: buying out of money options and wishing. As I said, delta is against you. Your probability of being in the money is lower. So if you buy out of money, that's a mistake. Timing the market, you cannot time the market in options. You have your implied volatility, you have your delta, you have a handful of features. You use that and make the entry in the market. And then trading illiquid stocks. So if you pick an illiquid stock, as I said, bid ask will be stretched out and you could just get burnt out, picking a wrong strategy. And then using the same strategy against across all markets. Is there one strategy which I can run for all markets? I mean, there's nothing like that. There's no silver bullet. So you cannot have a single strategy which you can use in all markets. The market direction, market condition is determined by your implied volatility. Implied volatility determines the strategy that you pick. Even if you're a buyer or a seller, based on that, you make your strategy and make the entry into the market. And most important, when I make an entry into the market, I first look for the door out. What is my exit plan? Even before I make the entry plan, what are all the different exit plans I have if it goes against? Have an exit plan always. You cannot be Abhimanyu and jump into the options ring and hope that you'll be able to win and make money and come out. You will die in the end. So you ought to have a exit plan. And position sizing, you have to know your account size. Position sizing, these are all future chapters that we will have. You will have to be sure as to what is your position, how much cash you can actually willing to lose on each position. And then you'll have to track your earnings, dates of the stocks which you are investing in, and selling in the money option. You don't sell in the money option. You normally buy in the money option. So if you sell in the money options, you're already, it's going to go against you. The topics that we'll cover are understanding implied volatility. We did cover it in our basic session. Here we will dwell a little more. We'll understand IV rank and IV percentile and how to go about using them. And then you have your option strategies. We will discuss the long call, long put, bull call, bull put spread. And then we'll have your neutral strategy, which is your iron butterfly, and our calendar spread. We'll also discuss the optimal strategy selection based on the IV. And then I've also put together one more item, which is options traders checklist. This is something that a handful of people have been asking me. So I've kind of put something together, and it could definitely be of some use for everyone here. I'm not a broker, dealer, or investment advisor. I have no access to non-public information about publicly traded companies. And this is not the place for giving or receiving any financial advice. All my presentation, please treat it, and all the trades that I show on Twitter or any other platform, treat it for educational purposes only. Before we get started, the most important factor that determines what option strategy that you would pick is volatility. By now, if you have done the basic course, you would have known that. So what is for other people's benefit, we will still touch upon volatility, and we'll go a little into volatility before jumping into IV percentile and IV rank. So what is volatility? Volatility is a percentage a stock fluctuates without any regard to the direction. It's a positive number, whether the market goes up or the stock goes up or stock goes down. It is measured. The fluctuation is measured. That is what is volatility. Volatility, you can split it into two. One is your historical volatility and implied volatility. So let's understand what is historical volatility. Normally, historical volatility, you measure it over 1 year period. And it is the measure of how much the stock price is deviating from the average. And it does not measure any direction. As I said, if it is up or down, it is a positive number which is taken saying this much it has moved. And then what is implied volatility? It is measured over the lifetime. It's a price value which is measured over the lifetime of the options, and it is an estimated price. So it is an estimate of the price expectations of the market. It is unknown and it is a derived value. You need a statistical model. You normally use back and shoal model. Put in all the other variables and you get the implied volatility value. Now understanding historical volatility and then implied historical volatility. So what happens is, as I said, volatility is a percentage the stock price fluctuates without any regard to the direction. Historical volatility is what has actually happened, what has been recorded as to what the daily movement has been. Now what is implied volatility? Implied volatility is the expectation as to what is going to be the move of the option price. If you were to plot implied volatility on a chart, it's going to be like this. And if you compare it against the historical actual recorded volatility, what happened, it tends to be a little lower than the implied volatility. What does this mean? The people's expectation in the market, whether it is driven by fear or greed, is always a bit higher, always or more often than not, a bit higher than what actually happens in the market. That's why your historical volatility, more often than not, actually is slightly lower than what is your implied volatility. Now, you would have known by now that implied volatility by itself, as a number has no meaning. You always see people saying that implied volatility is high, low, very low. So what does this mean? It means that you will have to compare it against another variable. So which is your historical implied volatility. If you compare your current implied volatility against your historical volatility, you would be in a position to understand, okay, where it is actually sitting. As I said, IV as such, a number doesn't have any meaning, and it has to be compared against historical volatility to know whether it is low, high, medium, or very low. And this gives IV the meaning. When the premiums are low, you do a debit strategy. When the premiums are high, you do a credit strategy. That's how you use the implied volatility for your trades. Now moving on, now we will understand implied volatility, the IV rank and IV percentile. As you are aware, India VIX tracks the Nifty's implied volatility. Here I have taken February 2nd, 2018. India VIX was 15.25. Now we will understand how to calculate implied volatility rank and implied volatility percentile. 52 weeks high and low of India VIX was 8.76 and 18.75. If you have done the basic course, you would be aware by now that IV rank, which is the annual number, the formula for calculating is current IV minus 52-week low divided by the difference between high and low implied volatility of 52-week. So 15.25, which is your current IV, less your low 52-week low 8.76 divided by 18.5 minus 8.7. So it gives you a 66.63 as a IV rank. The range is normally between 0 to 100. Sometimes it could be even higher than 100 also for a IV rank. Now let's look at IV percentile. IV percentile is number of days under current IV divided by number of trading days. Trading days is taken as 252. It's a standard methodology. 238 days in the whole year, the implied volatility has been below 15.25. That percentage is 94.44. Again, the range is between 0 to 100%. If you look at it, there's a huge disparity between IV rank number and IV percentile number. Both are measured from 0 to 100. If you look at IV rank, it is 66.63. IV percentile is 94.44. So let's try and understand why this is and what we should be doing, how to go about using this. As you would have seen, IV rank, it places your current IV in the market between the low and high of the historical implied volatility. That's what your currently IV rank does. But IV percentile gives a weightage. It looks at the number of days the current market has been below the current IV. The last 1 year period. So there is a weightage that has been given when you do the IV percentile. In the example where the India VIX was 15.25, if we were to rank it, IV rank gives 66.63, you say it's in a high zone. IV percentile gives you a 94, which is a very high zone. Why did this happen? During the budget time, IV rose significantly, and once the budget was over, it dropped. This kind of caused IV rank to miss out the high premium opportunity. What happened? IV rank is looking at 52-week low and 52-week high, and then says, okay, now current IV, where is it sitting? As the IV dropped a bit after the budget was over, it looked like, IV rank had fallen. It has moved from a very high zone to high zone. But when you look at IV percentile, it kept track of it. How many days the current IV was over and above the whole period. That is why IV percentile has given you a 94.44. When you're an options writer or options trader, you need to understand both IV rank and IV percentile. If you understand both, it gives you an edge. And when you pick a strategy, it will give you a kind of a understanding as to how the IV rank and percentile are working. You can use either IV rank or IV percentile when you're doing your trades, or you can look at both of them, how they impact your strategy when you take your trade. Now moving on to option strategies, there are a whole lot of strategies which are available in the market. So you would see that 50 plus strategies that people put together. We have synthetic spreads, you have your back spreads, and so many other names that you will come across, which kind of, if you're a beginner to options, you're trying to write some strategies, understand strategy, it kind of frustrates. If you were to ask me, just don't give so much value to the names. At the end of the day, stock market goes up, stock market goes down. You need to know whether the situation is bullish or bearish. So if you're bullish, you have a set of strategies. If you're bearish, you have a set of strategies. These are the standard names that you're seeing here. And then there is another category of strategy, which is your neutral strategy. Neutral is when you think that the market is going to stay within a range. You're not bothered whether it's going to be bullish or bearish, but you are expecting it to stay within a range. And then there's another category of strategy, which is a direction indifferent strategy. You're looking for a breakout trade. So when a stock is cornered and it's not moving too much and the volumes are building up, you could probably expect a breakout to happen. Or there's an event which is coming up. If it's a big event like earnings or a budget, there could be a breakout in the Nifty or in a specific stock. So that is a direction indifferent trade. You can learn all the different strategies over a period of time, but these are the basic strategies that you normally use in the market, and all the strategies that you would learn as you upgrade yourself, upgrade your skills over a period of time in the market are all somewhere interrelated to these only. In our discussion, we will cover our long call and our long put, and then bull call spread and bull put spread. And on neutral strategies, we'll cover our put calendar and iron butterfly. Option strategies, if you look at it, we also categorize them as debit strategies and credit strategy. What are debit strategies? Debit strategies are where you pay some money when you buy a call, when you buy a put. When you end up paying something out of your pocket as a buying, it becomes a debit strategy. I call it as a capital appreciation strategy because when you buy a stock, you expect the stock price to move up. It has to move somewhere. So that is why it is a debit strategy and a capital appreciation strategy. With respect to credit strategies, they're all income earning strategies. When you do credit strategy, you are always having a range in your mind. When you make a trade, you're looking at a range or you're looking at income coming into your pocket than anything else. As I said, there are various names which have been given. So you would also hear bull call spread and bear put spread being called as vertical spread. And then you would hear iron butterfly being called as iron fly. There are various names that are given. Moving on to the strategy. Now on the capital appreciation strategy, which are your debit strategies. So we will discuss three strategies, which is your simple long call, long put, bull call spread. While they sound simple, there are definitely a good bit of dynamics behind it. And if you understand it, then you would be in a better position when you take the trade. I have organized it into 4 boxes. So first one on the long call, when do you make an entry? Long call means you are bullish in the market. So you have a bullish outlook. If you're looking at a stock, you are expecting the stock to move out. So when do you make an entry for a stock when that you are expecting it to move up? When it is at a support level. You exit at resistance, or you've already achieved a profit target, or you have set up a stop loss where the stock is not rising and it is falling down. You exit the trade. What is the advantage of taking a long call? The advantages are the upside is unlimited, like in sense that it can go as high as the stock keeps climbing up and up. The loss, as I said, it is a limited risk strategy, so loss is capped to the premium that you're paying. It's a single leg. How much premium you pay in the debit, that is all is the loss. And it is definitely cheaper than the buying stock. Disadvantage, you need to get the direction right. So I've not been able to figure out the direction so easily. So if you are able to figure out the direction, you know technicals, you are well versed in technicals, you can run with stop losses, you get the direction right. Once you get the direction right, you will have to ensure or at least hope that the stock rises and covers the premium that you paid to buy this call. What is the setup? You buy a call. And you buy it normally in the money or at the money. You don't go and buy out of money calls. Why? In the money calls have a better success rate of being in the money because delta is the value that you need to look at. So in the money calls have a better delta. And you should try and get into the trade 30 to 45 days to expiry. That gives you an advantage. Say if the data is on your side, the premium will deteriorate slowly. And you will have to pick up the trade when the IV level is low. When the IV is low, the premium is low for this strategy. If the IV is high, as you would know that the premium would be higher. So you get into this trade when the IV is low. So this is a typical setup. Now let us look at an example. There is a single leg long call option strategy. ICICI Bank, the stock price is at 330 in this example. This is an actual trade that I've taken in the last webinar that we conducted on simple option strategies. This is a February series 1. ICICI Bank stock is 330. In the money call, you buy for 320. The premium that you would pay is 17 rupees. The lot size is 2,750 and the net cost for this trade for you would be 2,750 into 17, 46,750. Here is the payoff diagram below at the bottom. The premium that you paid is 17 rupees. You bought a call of 320 plus 17, 337 rupees is your break even. The stock has to be above 337 for you to start making money. Currently, the stock is at 330. Your expectation is the stock to move higher from the current level to at least by about 7 rupees for you to start seeing money. This is a simple long call where you're really sure about the direction that it is going to go higher. Ensure that you pick up a liquid stock so that you can exit it easily. If you pick up a very illiquid stock, like if you're Just Dial or those kind of really illiquid counters, the bid-ask spread will be so wide, and you will get trapped in it. Either you're entering the trade, you will get trapped, or when you're exiting it, again you will get trapped in it. And then you have to buy ITM strike because delta advantage is necessary for you. And then you have to enter as early as possible, if possible again, so that you have a low theta decay. As you get closer to expiry, premium decays fast. And then implied volatility must be low to neutral, which will help you to reap the benefit. Where the implied volatility rises, the premium will automatically rise for you to start making money. Moving on, next we will look at long put. The opposite of your long call is your long put. When do you make an entry into a long put? When you have a bearish outlook to the market and you make an entry around the resistance, and the exit would normally be at about support, or when you receive when you're at the profit target, or you are hitting the stop loss. Advantage: the profit is up to the stock actually going falling and falling and falling up to zero value. You're going to have your profits. And the loss is again limited because it is a limited risk strategy. The premium that you pay on the debit is all the risk that you have, and it is cheaper and less complicated than short selling a stock, because you cannot carry forward, and doing futures. This is very limited because futures, if you do, you are open on both sides. So this is a limited risk strategy. Disadvantage: again, you need to get the direction right. You know that the stock is going to go down. You really need to be sure of that. And when it goes down, it has to cover the premium also that you paid for it. Setup: again, like calls, you'll have to buy in the money or at the money put, and IV has to be low, implied volatility level has to be low. Theta again has to be more, theta needs to be there. So 30 days to 45 days to expiry is very good when you enter these trades. And then delta in the money, better success. If in the money is bid ask is not good, then you probably look at it at the money. Again, an example, we are looking at ICICI Bank stock price 330. If you were to buy a in the money put, in the money for this would be 340. So when you buy a 340 put, the premium is about 15 rupees. The lot size is again 2,750. The net cost for you is 41,250 rupees. So what happens to the break even? 340 is where you entered it. 340 minus 15, 325 rupees is your break even. Currently stock is at 330. So you're expecting the stock to go down for you to start making money. So it has to go down at least 5 rupees, 325. So you can cover your premium that you paid, and then you start making money. Again, it has to be a liquid counter in the money for better delta, entry as early as possible, and implied volatility is low. As I said, when the implied volatility is low and there is the rise in implied volatility, automatically the premium will go higher. Even if the stock is not moved down, if the implied volatility is low, you have a chance that when there is a rise in implied volatility, for whatever reason that it rises, it will be an advantage for you. These are the two simple one-leg strategies that you can do if you're beginning an option, so that, and you have to keep in these factors in your mind when you enter the trade. Now let us look at next level, two-leg strategies, which is bull call spread. It is a bullish outlook strategy. You are a bullish, and like a call, you enter at around support and you exit at about resistance and the profit target, or when you hit the stop loss. Advantage: it is a limited loss strategy and it is cheaper than buying a call. Why is it cheaper? We'll get to that shortly. Disadvantage: where the call has an unlimited profit, wherein since as high as the stock is going to go, bull call spread has a limited upside. Again, you need to get the direction right because it's a debit spread, and the stock has to move above the net premium that you're going to pay. How do you go about setting this up? The setup is you buy in the money call, like simple call that you did. You have to buy in the money call, and you sell out of money call. When you sell out of money call, what happens? You get cash inside. When you buy, cash goes outside, debit. When you sell, you get cash. This is a two-leg strategy. Implied volatility again has to be low, and theta 30 days to expiry is also okay for this. Again, we'll take the same example of ICICI Bank. Remember the call that we did? We did a simple 320 in the money call. We paid a 17 rupees premium. Here we are selling a out of money call for February. Call premium is 7 rupees. It's a two-leg strategy. There is selling is also involved. So what happens? Buying, you pay 46,750, same like a normal call buying. And for selling, margin is required. So depending on the broker, if you dare to take a big brokerage firm or probably even Zerodha, this is the margin that is required for selling one lot of ICICI Bank. It's about 1,30,584 when I calculated it last. And then net total investment is required as 1,77,334. Here in this case, your max loss is 10 rupees. Why? You already sold a premium. You bought for 17, which would have been a loss if you had just taken a call. Now you sold a premium. So you got 7 rupees into your account. 17 minus 7, maximum loss possible is only 10 rupees. And the profit is again limited. Your profit is limited to again 10 rupees because you've already sold a call. In this case, the interesting part is the break-even is at 330. The stock price is 330. The break-even is also sitting at 330. All it requires is the stock to just move a little you will be in the money, you will start making profit. Unlike a call, you will start making money only if it covers the premium that you paid. Here, you're already in the money. You're right at the money, and you will start making money. As I'm assuming that you got the direction right, you will start making the money immediately. Here is the table which shows the comparison between call buying, the naked pure call buying, and bull call spread. The maximum loss, if you see in the call buying, is 17 rupees. That is the premium that you paid. Here, it is restricted to 10 rupees. The break even, where in the call, it was 337. You already had to move 337 for you to start making money. In a bull call spread at 330 and above, you will start making money. The return on investment, call buying, as I said, sky is the limit, but be fair. I mean, how much is a stock is going to move up by? I doubt in a month it's going to move up by 10%. It's going to move up and come down. It's going to keep shifting up and down, right? I wouldn't really tag it there and saying what is the return on investment. Somebody asks for a call, I would say I don't know. But for a bull call spread, I know my return on investment. $10 is what I'm going to make. 27,500 is the return that I'm going to make. On the total investment, it is about 16% return, which is fantastic. You get your direction right, and right from the moment you get your direction right, you will start making money when you do a bull call spread. So when you make a strategy, you are eliminating the risk. Though you are restricting the profit, but you're eliminating the risk. That is why you make strategies to eliminate risk and lock in the profit. If you're picking stocks, liquid counter, you have to buy in the money call and sell out of money call. In this case, we said stock price was 330. We picked up a in the money 320 call and we sold a out of money 340 call. Entry as early as possible for theta benefit and implied volatility low to neutral is okay. Now, moving on to the interesting part. These are income strategies. So we'll discuss bull put spread, iron butterfly, and calendar spread. Bull put spread is a 2-leg strategy, and it is simple. Iron butterfly is a 4-leg strategy, and then you have your calendar spread is again a 2-leg strategy, but it is kind of involves 2 months together, so it could be a little more complex. So I've kept it last so that I can take some time and explain it clearly for you guys. Moving on, bull put strategy, 2-leg strategy. Entry, again, this is a bull, but you're using puts to do this strategy. So your entry is normally bullish outlook, but it also gives you a range benefit. You're looking at a market being range bound to bullish. Say you're looking at a market where it is at a good support level and you're expecting it not to go down further too much, and there's a good chance that it will go higher. You are bringing in a little more flexibility element in this. When do you exit it? You exit it when it hits the resistance or you have a profit target, or of course again at stop loss. Advantage is that it is a limited loss strategy and it is an income strategy. You're trying to make income in this, and then it does not require the market to move. The market doesn't move, still you would make money in this strategy. Disadvantage, the risk versus reward in this strategy is not too good. I'll explain it to you why. And then the profits again are limited. The setup goes like this. You sell out of money put one strike away. If ICICI Bank was 330, you sell one strike away out of money put, and then you buy a couple of more strikes away out of money put. When do you enter the strategy? Because this is a credit strategy, you're selling at the money where you're taking in more premium. You're selling it when neutral to a high implied volatility. And theta, you'll have to ensure that it is less than 30 days. 30 days and less to expiry, it is better when you move into the strategies. Any credit strategy, you have to keep theta less. Now, this is an example where I've used TCS. TCS stock price is 3,000. So what does the strategy say? It says, okay, you have to sell out of money put at one strike out of money. So I'm selling 2,900, which is one strike out of money. Premium is 40 rupees. And I'm buying little furthermore out of money, 2,800 put, the premium is 20 rupees. So what would be the cost for me? The margin for selling one lot is 1 lakh, and then buying put at 2,800, I'm buying 250 into 20 rupees for that put. So that's about 5,000 rupees. And total investment that you would make in this kind of a trade is 1,05,000 rupees. Now let's look at this trade. Your maximum profit is the net premium that you received. What is the premium? You got a premium of 40 rupees and with that premium, you bought 20 rupees premium. So 40 minus 20 rupees is your maximum profit that you would have. Maximum losses, as I said, it is a bit stretched out. It is 80 rupees. How do you calculate maximum loss? Strike price difference, 2,900 minus 2,800, 100 rupees minus net premium, 40 minus 20. So 100 minus 20, you get 80 rupees as your maximum loss. The interesting part here is your break even is at 2080. The stock price is at 3,000 and your break even is below that. So what does this mean? Your stock price has to fall by 4% for you to actually start losing money. You're already 4% in the money. If the market stays anywhere between 3,000 to 2,880, you will have the money. If it climbs up, you will keep the same 20 rupees premium. So what is the return on investment? 5%. 5,000 rupees on about 1,05,000. It's about 5% return on investment. This is a fantastic strategy. What? I do nothing. 4% break-even benefit that I have the market and I've got the direction right. And I also have a margin of error when I got this direction. So a break-even calculation is selling strike minus net credit. 2,900 is the selling strike minus 20 rupees is your net credit. So this is a good strategy where you know the direction, but you're not sure, but you're kind of bullish in the market. You can just sit idle. You'll still get your money in. 5% return is fantastic. You'll have to sell out of money and buy a strike below it. And implied volatility has to be neutral or high for a higher premium for you to get in. Now, this is my favorite, and it's kind of a balanced strategy, which is your iron butterfly. It's a 4-leg strategy. Entry, normally enter it in when the market is in a range. Exit is when your profit target is achieved. This strategy, iron butterfly, gives you a lot of flexibility to adjust your trade and keep minimizing your losses. Your loss can be reduced over a period of time. When you make an entry, you may enter with a specific loss, potential loss, but you can keep reducing it over a period of time. So that's the power of your iron butterfly. Advantage, limited loss, and it is an income strategy. Disadvantage, again, it's a limited profit. For some people, it is not so lucrative that it is a limited profit. For me, it's fantastic. But it's a disadvantage, it's limited profit, and it requires the market to be within a specific range. Setup, as the name suggests, a butterfly. So you have a body and a wing. So body is normally your sell at the money call and at the money put. And then you buy out of money call and out of money put. This is the setup for this strategy. When do you make the strategy? You have to have an IV level greater than neutral to high or very high. You enter into the strategy. And theta, of course, 30 days or less to expiry. It is good to enter this strategy. Now let us look at an example of iron butterfly. This is on Nifty. Iron butterfly, Nifty on 7th of February, 10,476. What do? You make an at the money sell, right? So you sell at the money PE, 10,500, 185 points. You sell a call, 10,500, 135. So net credit that you would get for the sell is 320. Then you go ahead and buy the wings, which is your support. You buy a out of money put, 10,282 rupees. Out of money call, 10,800. So you kind of balance it, keep it in the center. For net debit that you would pay out is 120 rupees. So 320 minus 120, 200 points is your net credit that you take. So if you were to take a net credit or 200 into 75 contracts mix, so it's about 15,000 is your net credit that you're taking in, maximum possible profit in this trade. So maximum profit is 200 points. And maximum loss is 100 points in this trade. The capital that would be required for this trade is, if you were to sell Nifty, as I said, depending on the broker, 1,10,000, and you're buying one put and one call, which is about 9,000. So total capital involved is 1,19,000 rupees. So 15,000 by 1,19,000, so about 12.6% is your return on investment if the market closes at the center, which is center is what 10,500 is where you entered into the trade. When you enter into a iron butterfly, you get a break-even point. So break-even point is what? You have your 200 points on both sides, right? So you have your 10,300 is your break-even point on your put side, and on your call side, 10,700 is your break-even point. If it stays within this range, you will make money. If it goes beyond this range, you will start to lose money, but your maximum loss is limited to 100 points only. What happens is when it starts breaking these ranges, as you get advanced, you will start doing adjustments. When you do those adjustments, your losses will also be lower. You will try and keep the credit that you did, and you will reduce the loss further and further. That's what is an iron butterfly strategy. This is how it looks. Next, moving on, we will look at calendar spread. This is a 2-leg simple strategy. Entry, you normally make between the range or at support or at resistance. It can be made at any given point of time. Okay. And you exit normally at your profit target or when the adjustment is not possible. Or if you have a stop loss, you can exit it at stop loss. It's a limited risk strategy, so you can keep it open and you can learn how it works out. So advantages, it's a limited loss, again income strategy. Disadvantage, limited profit. It requires the market to be in a specific range. How do you set this up? There are two ways to set up two calendar spreads that you can do. One is your call calendar and another is your put calendar. How do you set up your call calendar? You buy next month call and you sell current month's call. Same strike price you take it. If you were to sell Nifty 10,500, you are selling this month. Next month call, you'll have to ensure that you buy the 10,500. Same way in put, you do the same thing. You buy the next month's put, same strike price you sell in the current month. That's the setup for this strategy on a calendar strategy. Now let's look at an example. So as I said, same strike you need to do. You need to buy the next month and sell the current month option. Nifty, let's say the spot is at 10,600. Normally when you do a put, as you would learn adjustments, you normally do one strike away from the current spot. You can also do it at where the spot is also not a problem. So I've done this at a 10,500. I bought March 10,500 put at 185 rupees. This is a put calendar. And I'm selling 10,500 put at 100 rupees. Net, I am paying. So that's why it's a debit strategy. So I'm paying 185 and I'm selling, right? It's at 100 only. So net debit is 85. So when there is a net debit of 85, that is the maximum possible loss that I can incur on this trade. This trade, when you enter, you will have to exit at the current month expiry. So here we entered into the trade in February. We sold February and we bought the March contract. You cannot carry forward to the next month. The problem with this trade is that you don't know the profit. You don't know the break even. It is something that you need to keep tracking it on a daily basis. Why? Because there are 2 months which are involved in this. And it is driven by the implied volatility. Implied volatility varies from 1 month contract to another month contract. When the implied volatility is low for the next month contract, if it rises for the next month, the premium is going to go up because it is a debit, more premium, you get into profits faster. But if the next month's implied volatility falls, the premium will fall. If it falls, your profit level could come down. So that is the problem with this strategy. Calendar, while it is a very cheap strategy for you to do, you'll have to keep in mind you enter in a low volatility environment where there is an expectation that the implied volatility will rise. What does this mean? You're selling current month put at 100 rupees and you bought 185 rupees in the next month. So what happens as the period goes by, the premium starts decaying in the next far month, right? The 185 will start falling down. But if you enter at a low volatility environment, what happens if the volatility rises? When the volatility rises, the premium shoots up. You would have an advantage of premium rising because of implied volatility rise. You'll have to enter early into the expiry and then you'll have to exit at the current month expiry. Let's look at it with an example. In scenario 1, we said that Nifty February series expired at 10,600, which is out of money. For this series, we said, okay, we entered into a contract of what 10,500 put long, which we bought for March, and February 10,500 put, we went short. The premium that were 185 we bought and 100 we got as a credit. Market has expired at 10,600 out of money. So what has happened? 10,500 put has decayed over this 1 month period. The value I have put it as 120 rupees, 120 points here. And February 10,500 has already expired. So it's expired out of money. The whole thing is your profit. So you have your 100 rupees profit, which is coming from your February short put that you did. And then because of your decay in premium, you lost 185 minus 120, 65 rupees on the March contract. So net profit is what? 100 minus 65, 35 rupees, 35 points is your net profit that you would get if the contract expires out of money at this level, 1,600 out of money. So the trade capital is what? One lot you're selling, right? So 55,000 and then you bought one. So net capital is about 62,500. It's a small capital. You're not employing too much capital, but the return is about 4%, which is fabulous. On a second scenario, February series, let's say, expires in the money at 10,200. You entered into the March contract at 10,500, right? So it is closed in the money. So you're going to be in profit. So 185, the closing is about 335 would have been with the decay in premium due to theta. So net profit would have been 335 minus 185. You would have made a profit of about 150 rupees on the March put, which was long, because the market went down. You make money when the market goes down when you have a put. But at the same time, you sold a put, right? The current month put. So you lost, the closing value is about 300 points you lost, right? 100,000, 10,500 was the put at. You shorted, the market closed at 10,200, so it's about 300 points it closed at. So the loss is 300 minus 100 premium that you already took for this contract. So net you lost 200 points. So 150 minus 200, so net loss on this trade is about 50 points. So 50 into 75 contracts, which is 3,750, which you will end up having a loss of about 6% on this trade. So these are the two different scenarios. If you do a put calendar, what happens? If it expires in the money, if it expires out of money. Remember, at worst case scenario, you will at worst lose your 85 points. That was the trade that you entered, right? Which is your 185 minus 100. That's your debit. 85 points is your debit. That is the maximum that you would ever lose in this trade. Moving on to the next, what I did was for the weekend, I tried to put together a put calendar spread. When Nifty is at 10,490, if you look at it, I have made a trade where I have shorted put a 10,400 March series and I have bought 10,400 put April. So the net is 118 short and long is 166.9. Below is your strategy summary table. What you get is, yes, the maximum profit potential is 106 only. Maximum loss is higher because the implied volatility right now is a bit high. It's not definitely at a low level. That is why you have your risk versus return not properly aligned. So if you look at the upper protection and lower protection, the market has to go beyond 10,768. That is about 2.64% for you to start losing money. And on the lower side, it has to go below 10,181 for you to again start losing money. If it stays within this range, you will get some profit out of it. All these trades can be adjusted that you can learn over a period of time, or you can Google it, or over a period, I would probably put together how to make adjustments. Or you can, of course, join some classes where they will bring you up the curve faster. Now that we finished the strategies, let's understand the grading. You remember the implied volatility grading, no, low, high, neutral, and these are the kind of gradings that we did. If you had attended the basic course, you would have seen that we said, okay, 20, 40, 60, 80, and 100, we'll grade it as low, very low and all. So this is the kind of grading that we have for implied volatility. We can do the grading based on implied volatility rank or implied volatility percentile. How do we apply this? Now, if it is below 20 or below 40, you would look at debit strategies, because when the implied volatility is low, you are trying to take the advantage of low premium, entering into a debit strategy at a lower rate. So if you look at the greens, which are all your debit strategies, both the calendars are all our debit strategy, put calendar and call calendar, but it is an income strategy. That's why I've colored it in blue. So these are low volatility strategies that you normally take. When the volatility is high, you start moving at different strategies where you look at iron condor, your bull put spread, bear call spread, your short straddle, short triangle, and short puts. So as I said, calendar spreads, they are income strategies, but they are debit income strategies. And then when I say spreads, the spreads can be done even when the market is at about 40 to 60. So this is the strategy map you normally would employ in the market. So you'll have to say, okay, the implied volatility is low. So I can look at, if I'm looking at a credit strategy, I have only calendar spreads for me. If the implied volatility is kind of neutral, I can look at iron butterfly. If it is rising, I can start looking at iron condor. And then if it's really high, I can look at straddles. But you don't look at a debit strategy when the implied volatility is very high, because you would end up paying very high premium. Debit is what you buy something, right? You would end up paying high premium, and the market has to move beyond a point for you to actually make money. So the market move required to be way higher in a debit strategy if you're doing it in a high volatility environment. So this is in a nutshell as to what kind of strategy you need to pick for what kind of implied volatility. If you have not seen this before, if you have not known this before, say 80% of the people who go out there and do something in the market with respect to options are not aware. Remaining 20% is kind of aware of what happens and how to go about doing this, and they take advantage of implied volatility, rank and percentile, and aligning a strategy with it. Now next, this is what I've put together as a checklist for option trader. This is what I normally follow when I look at options. What do? I pick the most liquid underlying to write options on or buy options on. Index, Nifty is what we normally prefer if you're beginning, and then you move to stock. What do? You look at every day, end of day, you look at implied volatility, rank and percentile of each of these liquid underlyings. You have your Nifty and all the stocks which are liquid, you look at it. So where can you get your IV rank and IV percentile? I've told you guys before, Trader Lounge has it and Capital Minder has it. It's available for free. And then I look at any events are coming up, any RBI announcement is coming up. If a stock's IV is extremely high, I look at why the IV is high. Is there a earnings coming up? What is the reason the IV is high? And if I'm thinking that the IV is high and it's going to fall, why would it fall in the future? That is something that I look at. IV is low, it is okay, but IV is high, you will have to look at why it is high, because as an options writer, you're looking at the premium, it is high, so you'll have to know why it is high. And based on the IV, we select the instrument that we're going to use for buying or selling, whatever we're going to do. We look at the IV, and IV rank says, okay, it is low. So I say, okay, so this is the rank of this IV. So I'll have to look at a strategy which is low volatility strategy, which is a debit strategy that I'll have to look at. So you need to have a theory when you do this. If you're a directional trader, you need to check whether the stock is at support, resistance, or within a range when you write the strategy or when you buy a debit. And if you're a neutral writer, just pick the neutral strategy that you want to deploy. If you're a low IV environment, you can pick up calendar. If you're a neutral environment, you can pick up iron butterfly. If it's a high IV environment, of course, you can pick up straddles and strangles or iron condos. And then you use the theta and delta knowledge that you would have acquired over a period. So, if you have done the basic theta, if you enter early in the trade, and debit strategy, the theta decay will be lesser. And if it's a credit strategy, if you enter a little later, it is better. And delta, if you are in the money, your probability of winning is higher. So you use this when you make your strategy. Then this is the most important thing that you need to know. You have to check whether the strategy is aligned to your temperament. If you're a directional trader, if you're taking a neutral strategy, it is going to confuse you. So you'll have to understand what is your temperament, now how you can manage this trade, whether you can actually look at it as a directional or non-directional trade. That is something that you'll have to keep in mind. And how much loss, if it is a loss that is coming out of this trade, what is the maximum loss that you get in a trade? You'll have to see whether it is something that you can take. And also you need to know whether you need to check whether this trade requires any constant monitoring. If you enter into a debit strategy like a call or a put single leg, you will have to monitor it constantly, because call or put, it is directional. All directional strategies start making money very fast if you get the direction right. At the same time, if you get the direction wrong, you lose money very fast. Though it's limited loss, I'm sure you don't want to incur the full loss, right? So you need to have this check always done. And then risk versus return, you'll have to keep at least about 1 to 1.5. Sometimes I don't do it, but when you start, you probably look at 1 to 1.5 at least versus your return versus your risk that you have. And you have to pick your right position sizing. Do not go ahead, if you have 5 lakh, do not go ahead and write for the whole 5 lakh. You'll have to keep your position size small so that you will be in a position to survive any adverse movement that happens. Smaller the position size, you can actually take a little more risk when you take this trade. And do not risk more than 5 to 10% of your capital. So when you make a strategy, the loss that you would get, if it's about 5 to 10% max, then it means that you can survive. Worst case scenario, you're going to lose only 10% of your capital. So tomorrow you can come back and make another trade. Then have an exit plan. When you make all these things, keep in mind that you need to have a compulsory exit plan. What if IV changes? What happens if you're a high IV, you bought it at a neutral implied volatility, you've written a strategy. And what happens if the IV rises drastically? What happens? Because it's a credit strategy, if IV rises drastically, your profit potential starts falling down. So what is that you're going to do? If you're written a debit strategy and the IV falls even down further, what happens? You'll have to keep in mind what is the impact of IV on your trade. And what happens if the break-even is breached? Like you put up a calendar, there's a break-even in a calendar. If you put up a iron condor, you have a break-even. We have an iron butterfly, we had a break-even on both sides. So if it breaches, what is it that you're going to do? You're going to wait for the loss to come up, or you're going to do an adjustment. These are the things that you'll have to keep in mind. And will you be able to take paper losses? So what happens is, if the implied volatility rises drastically, when you take a credit strategy, like you take an iron butterfly, and still the implied volatility has risen drastically, you would end up in a paper loss. In sense, you will be within the range, but because of the implied volatility rising, it will look like you might be in a loss. So how much of paper loss you can actually sustain? That is something that you'll have to see. And whether your broker is allowing you to have that kind of a paper loss. Some brokers do not allow that kind of a stretch in your account. And then when will you book your profit? And when do you book a loss and walk away? That is something that you need to keep in mind. You have to plan for your exit, which is very, very important. And I said when to make the adjustment and keep the trade active. I normally keep making the adjustment as much as possible and keep the trade active so that I stay neutral in the market and I can at some point of time come in the money. So remember, most important, accept every trade does not necessarily result in a profit. And if you make a loss in a trade, do not chase the next trade saying that I have to make up the loss that I made on this trade and somehow I have to make up this loss. If you incur a loss, just book that loss and move on. Next trade, you cannot make up a loss on a previous trade in the current trade. Current trade has its profit potential and loss potential. If you breach the rules wherein you said your implied volatility is neutral and you go and write a short straddle or a short strangle, you will be in trouble. So you'll have to keep these things in mind when you do the trade. So that's about it, guys. This brings us to the end of the session.